Everyone, I want to thank you all for being with us today. Hey, Jen, joining us. We are going to be talking about construction perm loans. We got a lot of new products coming out. We're really excited about, and we think there's a big niche for you as a realtor, and also for your clients, whether they're the borrower that wants to build or that builder that you're trying to work with. Okay, so we're going to be going on a lot of new programs here, and my name's Tim. Branch manager of VanDyk Mortgage. We're right here in Fort Myers, and you were either invited on this webinar by myself or a lot of our loan officers. We have several of them on this call. They more likely invited you here, so we appreciate y'all being with us today, and hope you get some good knowledge out of everything we're going to be talking about. And to talk about it, by the way, and I want to make sure I say this, we have FHA 3.5% down construction perm, VA construction perm, conventional. You're going to have a VA loan, like I said, and then bank statements for self-employed borrowers and also investor loans. That's what we're going over today. So to do that, though, I got my buddy here, Matt Schedinger, and he's with us today, and I'm going to be handing it off to him, and he's going to be running with this. And so everyone is muted just because, you know, Zoom calls can get crazy. We want to make sure you stay muted. If you do have a question or anything, pop it in the chat. We'll be opening up for questions at the end as well. So just keep that in mind. I'll be monitoring the chat. I'll be jumping in, helping Matt out with questions and stuff like that if you guys have any. But this will be interactive as we go with the chat. And then I said at the end of the questions as well. So Matt, are you ready to go, sir?
Absolutely. I'm ready when you are.
All right, man. Show's yours, buddy.
Fantastic. Hey, everybody. Thank you for joining the webinar. On behalf of Tim and the team, we love it that you're here, and we'll be able to help you sell more homes with this program, we hope. And I'll get right into it. You know, we're going to kind of go through what a single close construction to perm loan is, what sets us apart from the competition, product offerings and key highlights, and then explain really soft costs, hard costs, and acquisition, so you can understand what that really is and when you're talking to your customer, the process, and how to get started. So what is a single loan construction? It's the power of two loans, a construction loan and a permanent loan, all built into one settlement for the borrower. What we mean by that is if you take a borrower and as a realtor, you want to get them closed, you go with and find a builder at a lot and they buy it. We're closing in 30 days. You're done. So that process is over. There's a loan, and they've got, what's great about it is they have bought the land or paid off their own land, budgeted for all the construction and associated fees into one loan, that when they close, we start giving them draws and paying out to the builder. So the builder can build their home. And at the end, and let's say at 12 months from now, we just simply modify the note. So they get literally their rate, their fees, everything they know is before they've even started building the house. So that's the really great thing about this, because it also provides protection for the builder, you know, against borrowers that don't have financing anymore. You don't have to requalify. As long as you close a loan in less than 12 months, there's no requalification on conventional loans. There's never a requalification on an FHA or government loan. So what's really powerful about that is I'm sure you guys have had borrowers that in the middle of the process get in there and then, oh gosh, my car broke down. I had to buy a new car, and they got a $1,000 monthly truck payment, and now they can't afford the home. So that's an issue. They also have an option for the permanent loan and rate are approved and locked prior to the close. So they can know their loan and what their rate is for a year from now when they convert. So that's what's really good about this. It'll also help your builders. You can go out to your small and mid-sized builders, offer this product to it. If you have a relationship with a builder or you want a relationship, you could bring builders or buyers to them, or maybe they've been doing the financing themselves and now the rates are higher on that and they don't want to pay that anymore, but they're happy to have a customer do it. This is a great option for you. And again, because there's only one closing, you don't have that second set of title company charges, processing charges, underwriting charges, title attorney's fees, and all that fun stuff. So it's really a great program on those aspects. You know, what's different from VanDyk and the other guys? Let's talk about it. Again, you don't have to requalify at all unless you go on a conventional loan longer than 12 months to build the house. The permanent rate is locked up front and guaranteed. The team has over 100 years of experience that do these loans, the CTP and Reno. So this is unbelievable, right? Think about that experience all coming together. There are no excessive overlays. I'll talk about 4 or 5 of the little things that you need to be aware of, but really it's what comes right out of the underwriting from the decision. So in the findings, which is in all regs, stuff like that, it's really easy to understand. We didn't want to put more constraints on it. Another big thing for your builder, we're going to give your builder 10% deposit at the closing up front. So they don't have to provide a permit. They don't have to give us receipts. We're going to pay that to the builder to get them started. That way they have some capital. And then we structure it with 5 draws after that. So it's kind of a good program, and it's got a lenient, we can do more. We just need to talk about it if they need more draws for whatever reason. We allow up to 12 months for stick built projects. And that includes down in Florida, if you've got, a block home or anything like that, you can do those as well. And it's all considered. The only thing that we differentiate is we do have, and we do manufactured and modular homes. We just look at them a little differently because they're built in the factories and they can go a little quicker sometimes. So we'll look at those a little differently. But the other big win here, we pay you at the closing. So you don't have to wait 12 months for this house to finish. If you're listed as a realtor in the contract and what we pay, we're going to pay that out then. So that's a huge win for you. A couple things that the other competitors do, they'll float loans. They make you requalify. So then you got to worry about, oh my gosh, is the borrower going to really get this loan and all that fun stuff. They outsource elements like builder review, project analysis, draw administration. We do that all in-house. So if you've got an issue or we got a problem, we can get to it immediately and get it fixed or whatever. We also have a really seamless transaction where it goes just from group to group to group. So it's all in-house, nothing like that. So you don't have any clunkiness for yourself. Also, a lot of competitors are capping the max they'll pay for land, right? I'll talk about our overlays on land, and there are a couple things to think about. But basically, as long as the deal makes sense, we're doing it. And that's what we want you to know. We really are driving. If the deal makes sense, we're going to do it. Many competitors are not able to go more than 9 months now. They're capped out on the 9 months on projects, so you can't even build to the 12 months. And again, some realtors' commissions aren't even paid up front. They're paid at the end when the home's completed. So those are kind of some of the bigger differences. Let's talk about the products that we offer on this specific product. So this is your single close construction of perm loan. We do max financing on the VA and USDA. So you can get 100% financing. FHA, we do 96.5% max financing. And conventional, we do 95%. Now, the key to remember for this is it's single family primary residences. Now, this is the first program. We're going to talk about the other ones in a second. A couple of our overlays. Let's talk about those. We do require an approved accept. So that's what's awesome, good there. The loan, when Tim and the team take the loan and do it, they know what is an approvable loan. They don't have to worry about guessing or trying to get different things. It makes it a lot easier. So that's one of our things. The second thing that we do is we do minimum FICO score requirements. So you have a 680 on conventional, 660 on the government stuff. Now, here's what I'll tell you. You got someone with a 658 credit score, don't say no to them. Get them in the system, see if you get an approved accept, and we can take a look at it and see if it makes sense. That's one of the things we do.
Hey, Matt, can we pause on that for a second?
Yeah, for sure.
I want to make sure you just made everyone check their Microsoft Teams chat, by the way. That pop-up came down on the right.
Sorry.
We're all checking it. No, I know I checked it. I just want to reiterate something from our point of view as a lender, and for the realtors that are watching this or if you're a buyer too on here, but I mean, having the ability to do a construction perm loan, VA 100% financing, FHA 3.5% down, and a 5% down conventional loan, like that's a unique product for y'all. There's not a lot of these options out there for people. And I just want to make sure that I kind of reiterate how important it is to remember this type of product when you're talking to your buyers or if you're interested in building. So I want to make sure I just talked about that for a second.
So,
thanks, Matt.
Yeah, no problem. Some of the other things that we do look at, we can't do the tiny homes. We get asked for that. So we do have a minimum square footage on the home. It does have to be 400 square feet. That is what we require there. The second thing on land, and I don't know how much you're going to run into it, but we cap really at 10 acres. We do up to 10 acres, no problem. If you've got an 11 or 12 acre, call me. We'll probably get it done. We will go up to 25 acre lots if there is a significant equity investment in the deal. Typically, if they own it free and clear, or they're going to buy it for free, or, then we'll look at it and do it. And again, that's all relative, right? Depends on what the price is per acre and stuff like that in the projects and stuff like that. But we look at the whole thing. So again, we'll look at exceptions above the 10 to 25 for those. The other thing, we don't do any down payment assistance loans for the FHAs. So unfortunately, that is one of our overlays. But you've just felt in what it was that the overlays are. There's nothing else. We'll do just about everything else. We do barn dominiums, we'll do modulars, we'll do manufactured, cement houses, everything. So let's go to the next. The cost associated here to do this, and this is what a soft cost is. A soft cost, so acquisition cost is made up of three things. You have the land, you have the hard costs. The hard costs are what you walk into the builder and say, hi, Mr. Builder, Mrs. Builder, I want to build my house. What are you going to charge me? And they say, oh, it's $400,000. That's the check that they need. So that's the hard cost. Fannie and the government agencies allowed us to add in fees that are directly associated with the construction, not closing costs that are like on a normal purchase or anything, but the cost associated with doing that. Because they realize the large tract home builders already are doing this. They're just putting it into the cost of doing the business. So there is a construction loan admin fee of $5,000. That covers everything to do. That covers your draw administrations, all the title updates, the inspections when we're doing the draws. It takes care of the builder review, the project review. All of that stuff is wrapped into one. And then the borrower has the option, if they want to, they can roll in their long-term lock. So if they want to, they can finance that as well. So it's a huge opportunity because the government understands this is what tract home builders are already doing. It's just in their margins. So it's really a huge opportunity as well. Let's see. I wish I could figure out how to turn that off. I apologize. There.
It's all good, man. That's the only thing crazy to pop up for you. That's all.
Yeah, no. I turned off the email. I didn't get that one. A couple cool things.
We do have a question here.
Oh, yeah.
From Janet. Can you field a question real quick?
Since construction takes an average 18, 24, 36 months to build, what happens after the 12 months? Is there another lock fee? Any deals on lengthy builds or right lock fees? So that's a great question. There's a couple different things to think about there. The first is on a government loan, you can continue to extend the loan as long as you want. The rate, it's 50 basis points for each 30 days that you extend. So you can continue to do that on a government loan. And we work with them and we have no problem. As long as the builder and the borrower are moving forward in the process, you're fine. On a Freddie or a Fannie loan, the conventional product, we don't have what's called a sellable loan after 16 months. So basically on this scenario, they wouldn't want to lock. And we have an option that's coming out where you're going to be able to float the loan for these situations. So what happens is at 12 months, you either have to look at what the going rates are at and look to extend and see if you're going to be done in the next 90 days. If you're going to be done in the next 90 days, because we really need you to complete by 15 months at that point. And at 15, because at 16, we have to get this loan done, closed, modified, and shipped to Fannie. The issue is if it goes past that point, you don't have a sellable loan. So what happens is we continue with the construction loan, we finish out the build, but the borrower is required to refinance into another loan because we can't sell that loan in that situation to the government. So that would happen there. I think that takes you. Can you build on your own land? Absolutely. You can build on your own land. If you own it, it's actually a great opportunity because we allow you to take the entire equity of it and use that as your down payment. So an example of that, let's say you owned your house or own the land for it, you paid $100,000 for it and you only owe 20, we'll allow the 80,000 to become the equity and the down payment. So they may not have to bring anything in. Okay. Kind of the process to start this is we always like to get real numbers to the borrower as soon as possible and get the builder accepted into the program as fast as possible. Because these are the two biggest mistakes people make. It is a little more different, right? The loan's a little different. There's some reserves and we have some construction. It's not your typical just regular purchase or refinance loan. So it's really important that you get the cost calculation worksheet worked out. We can do it. The loan officer does it for you. They get it. Then that way they can talk with the borrower and we calculate the exact structure. And we can structure it to maximize cash to close or whatever we need to do. So that's the first step. So they have real numbers and we can turn those around in 2 to 4 business hours. The second biggest step, and this, it's always listed 1 here because I always think this is the worst example or worst scenario for a borrower. Get your builder accepted into the program as soon as you possibly can. And the reason we put it 1 is I've had customers that, oh my gosh, they fall in love. They've got the program. They're all done. They're getting through the process. And we did get the builder accepted. And then the builder gets denied for whatever reason. That's a horrible experience because now that borrower has to go find another builder and they may have fell in love with them. So again, that can be a challenge. And the builder acceptance is pretty easy. We really want the builder to be someone that's been in business for 3 years, building single family primary residences and have a 680 credit score with $1 million in sales a year. And the reason we do that is we really don't want to be the builder. We don't want to be the builder's dance partner, the first partner at the dance. We want them to have known how to do this, how to build single family homes. And we don't want to we don't really want to approve people that are like flippers or renovators or commercial lending because it's so different building a complete brand new house. So we really look for someone that's done that and has a track record on it. Kind of the steps then, once you've got those 2 things done, the loan officer will put the loan together, put a submission, get it all submitted into processing underwriting. We do the project review. We've got all these things working, all those trains. And the best scenario example I've ever had is, I don't know if any of you had kids that love Thomas the Train, but I had a little boy that was just a diehard Thomas the Train fan. And I kind of say looks very linear, like you go step by step by step. You can be doing a lot of these steps at the same time. And it's all the important thing is we have to have them all back into the engine house. So the trains all go out in the morning, we get them all back at night. And I kind of use that before our closing. So once the loan is cleared to close and you're ready to go, we do schedule a pre-closing draw administration meeting where we get our building risk manager on, we get the borrower and the builder at minimum. We love it if someone's going to be involved. If you, the realtor, you want to stay involved, you want to be part of the process, you're more than welcome to come. The loan officer is more than welcome to come. But we get everybody on the same page at that point of how the draws are going to work and how everybody gets paid. So there's no confusion after the fact. We then go to the closing, and then that's when everybody gets paid, right? You as a realtor get paid. The builder gets their 10% deposit. The borrower's land may be bought or paid off at that point. And everyone's kind of moving forward in the process, and we build the home. And let's see. If you're working with a contractor builder that has history in another state and just coming to Florida, does this previous experience count? It does, as long as they're licensed correctly, right? So if it's the same company and they're not starting a new company, that's fine. If they're coming with their GC license, now they may have to get a new license because, obviously you'd have to have a GC license probably in Florida, but it's totally fine as long as it's the same company and owner.
That's a good question. We have another one there too, as well, and that is, how are you dealing with prices if they escalate during the build?
Good. Oh, I must have missed that one. I don't see it in there.
Oh,
Okay.
it's a direct message to me.
Oh, okay, got it. Okay.
They were going secret on you.
They're going secret. Okay.
So how are you handling price escalations during the build is the question.
Absolutely. So we actually build in we try to get a 5% construction reserve on all the loans. And what we do with that is exactly what you're talking about. We work off a fixed price contract, but we know things change and we know borrowers do change orders. So we try to set that up very beginning with a 5% because, there's a lot of times somebody wanted Formica countertops and now they want granite. So we know those things happen. So we build in a 5% contingency reserve. And what happens is, let's say that 5,000 or that 5% isn't used and the build goes perfectly, nothing's used. If the borrower brought money to the closing table, we can pay that back and cash on a conventional loan. On government loans and a conventional loan where they didn't bring any cash to the closing table, they use like equity of the land. What we do is a principal reduction on the loan at the time of modification. So when the house was all completed, we do the final accounting and we say, oh, well, you didn't use this or you had $4,000 left over. We can do a principal reduction. All right.
Cool.
Let me go back here. So we have, and you guys asked about a little longer build. We do have a 2-time product that we do as well. It's 9 to 15 months, and you can go out to 18 months with the 3-month extension. And it's kind of the negative here is it is locked. It's not locked. You don't have a locked rate on it. So that's the one thing you have to remember when you're going through it. So you're floating. So the borrower could be like, oh, okay, do I like this or not? Now, here's the great news. Where rates are at today, are they likely to go that dramatically up over the next 12 to 18 months? Probably not. So it might be a safer bet for some of your customers. So it's a different option for you. It is required to be 10% down alone. And then the really exciting program that we're rolling out as well that Tim's excited to talk to you about, and it really just is a great. So it's a non-QM single close construction loan. Now, a couple things here. This isn't hard money lending. So if you've ever heard that term and you know what that means, that's really expensive rates and fees. But this isn't a normal Fannie or jumbo loan program. This is really geared to people that are doing investment homes that might need DSCR loans where they can just qualify off the rental income for the new home, or they need a bank statement loan, or you need even the 24-month build time, right? So what happens on these, and we can kind of walk through them, we go all the way up to $2 million. We'll do builder spec. We'll do short-term rental homes like Airbnbs. People want to do it. It's really flexible income verifications, obviously bank statements, net operating income. We'll go up to 85% LTV with a 720 FICO. That's your best case scenario. So what happens then is you kind of reduce the fee, or the fees go up, or the rate goes up, or the LTV comes down, depending on what you're doing. So different things happen when you get down to like a 680 credit score and you lose 5%. You can lose another 5% LTV if it's with an investment property or a duplex. So let me show you a couple things here. So this is the single close. It's kind of what we do, right? We'll do 2 to 4 unit families. We'll do investment properties. We'll do personal or business bank statements. You know, you can go 12 months or 24 months for that. We can do it.
Hold on right there for a second.
Yeah.
So just so everyone's clear on these bank statement loans, we do these for just normal purchases. And what happens is all these people that you know that are self-employed, they don't claim their income on their tax returns, right? Like they don't. It's like, hey, I make $1 million, but I write off 980,000 of it. You know, like, well, you make 20. And so we always have to use what they tell the IRS. And if not, you got to go different ways, which one of them is a bank statement loan. That's where you use the average deposits for income. And you literally, almost every bank statement loan we have, I've done, debt to income ratio no longer is a problem. The AC guy, the electrical contractor, the roofer, whoever, the amount of money they have going through their business accounts is not even anywhere close to what they claim on their tax returns. So you really remove the debt to income ratio, and your self-employed borrowers are going to love this because they only have 2 options. Their 2 options are they either go and claim more income to the IRS the next year and the year following, or they redo their tax returns and pay the IRS however many thousands of dollars to get these tax returns fixed to make sure they qualify, or they have to do this bank statement type of loan with a little bit of a higher rate. And the majority of them are going to choose this higher rate product instead of paying more in tax return or in tax income to the IRS. So Matt, I just want to make sure I brought that up.
Yeah, absolutely. That's a great call. And here's what's really cool about this. We will build non-warrantable condos. They want money to do it. We'll do those. We'll do single families. We'll do 2plexes up to 4plexes. We've got deals where we had a person that wanted to own some land around a lake and wanted to put 4 individual homes on the lot so they could rent them out as rentals for the vacation home. So you can do that as well. We get really creative in here. Again, it's higher fees and higher rates, but just kind of think that in the back of your mind. This is kind of your out of the box stuff. We've got builder spec financing. So the builder wants to build their own home, or the builder wants to build a home to potentially have listed. And a lot of times the builders love this product too for theirs, because they're like, well, wait a minute, you'll give me money to build it. I don't really care what the rate is at the end because I'm selling. So they just factor in their fees into their costs. So it's a really good product that way as well. Kind of to get started, reach out to Tim's team. You can get there, get loans started, help you guys sell more loans. And just think we're here to be a tool in your tool belt to help you sell more loans. And that's kind of what we want to do, is offer you options and products that you can do that probably weren't able to do before. And if you were, at least hopefully these will give you more options and better options for it. So I kind of turn it over at that point.
Yeah, and just so everyone's aware, we're gonna have questions here in a second if you guys have any. But what we have is we have a whole team here of loan officers. I want to talk about something real quick that they probably were invited by one of them. Call their cell, text them if you have questions or concerns about anything regarding mortgages. We gave you our office line as well, but we have upcoming events. We're trying to find value to give to your business. We're in Southwest Florida. We got wrecked by Hurricane Ian. We just did a webinar on the 203H program. Today we're doing construction perms. In 2 weeks on November 16th, we're going to be doing another webinar. Matt, you're on it, so buckle up. But it's going to be all about renovation loans, VA renovation loan, the FHA 203K, Fannie Mae renovation loan, anything that we're trying to do to provide to y'all to help your clients that maybe had their house destroyed here in Southwest Florida or anywhere else. I mean, they do renos across the country, which we are licensed in a bunch of different states as well. We're going to be doing a business planning event. We have in-office lunch and learns, which will be for newer agents if they want to come learn about mortgages. And then we're doing a reverse mortgage webinar as well, December 15th. So we'll be sending these emails out to y'all. I just want to give you the heads up, kind of a call to action, plant the seed. These are going to be coming up for you to hopefully help you, your business, and everything else. So Matt, you did a good job. We're 30 minutes in. I want to open up to see if anyone has any kind of questions or concerns. We were hitting them in the chat pretty good. So that was a plus. But if anyone wants to, just raise your hand, or if you know how to use that option, ask a question, you're more than welcome to. Or if you know how to unmute yourself, do that as well. Everyone should be pretty good at Zoom by now, I would think. So Sherry, you got a question on there, Sunshine? I see you moving your camera around and stuff. You good? All right. So doesn't look like we have too many questions, Matt. You may have covered it, I guess. Oh, here we go. Oh, kudos all. There you go. Good deal. Thank you, Janet. Appreciate that. So if no one else has any other questions, we're going to wrap this call up. I just appreciate everybody coming on. Thank you, Matt, for doing your thing. Oh, there it is. I knew it always happens. Jen Ferry, is there any PMI on the first product for 95% down? I assume that'd be the conventional. So there, yep. You want to answer that?
Yeah, there is PMI on that loan for the 5% down. It's just like a regular conventional loan. Correct.
Yeah. And you're going to find the same with FHA and VA, the funding fees, the PMI, same type of structure as that. So good question though, the PMI, right? So does anyone else have any other questions? Oh, you're welcome, Jim. Thanks. Thanks for, Sherry, you good? You're waving your hand at me. You're good. Okay, thumbs up. All right. And then, yeah, Rochelle got it. All right, you guys. Hey, appreciate you being with us today. We don't have any other questions or concerns. We're going to wrap it up so y'all can get about your day. Kept it on 30 minutes. I'm pretty proud of us. Good job, Matt. You did well. Thank you very much for being with us. We appreciate y'all. Thank you.
Thanks, guys.